Everyone, and welcome to VLOG2 of my channel, Lake Effect Investments. Just starting up with this, and as you know, I did VLOG1, which was kind of an introductory background video, but I did talk about my own background and kind of what I'm looking to do with this channel. So do check that out if you haven't. And let's go ahead and move on and zoom into this right part of the chart here, the slide here that I talked about. Where I'm looking to, well, kind of already talked about that in the previous video, um, starting up with this stock portfolio as of kind of August 15th, 16th, and talked a little bit about the reason, the rationale behind that, looking at a multi-year low point, pricing low point for many of these stocks, which were worth an astonishing 2.6 million back in 2020 right now. And that, of course, it does include dilution of stocks, right? So I talked about dilution, what that is. So check that out in the previous video if you're not familiar, or you can quickly look that up on the internet. Probably a bit quicker that way. So yeah, let me just flash this real quick. So as I plan to go through specific sectors and stocks, here's a list of some of the key items that you want to keep an eye on, right? So very similar on both sides. You want to know what the key economic factors are affecting each of these stocks and profiles, any other key nuances, key impediments and risks, media narratives, and what the sentiment is on the sector and the stock. Is it bearish? Is it bullish? Is it something else? And of course, when you're looking at stocks, and I'll get into this, is you want to look at the income statements, balance sheet, and any other financial reporting that can help us make our assessments. So, as I mentioned previously, this particular stock portfolio, right, it's high growth, it's early life, so I kind of use that phrase instead of startup because these are not really startup stocks. They have been around for a while. Some of these may even have history, crazy history way even before the beyond the 5-year horizon. And they do have some fundamental traction to them. So they're not startups. I would just call them more like early life, right? And trying to get onto the path to maturity and the path to profitability. And it's like a breaking tech sector, right? So what do I have? I've got EV, hydrogen fuel, biomed, AI, robotics. And breaking out from that, we'll look at real estate investment trusts because I do have an interest there. Done a lot of real estate related stuff during my career, so want to keep an eye, want to keep a window open to that. And there's some interesting stuff going on over there as well. So maybe a video in the future dedicated to real estate investment trust as well. But looking at these guys here, um, this group, and particularly these three down here, right? This guy over here, ARDX, is a little further down the curve. So what you get the characteristics over here, which you're going to see is that these guys are highly conceptual, right? Or ideological. So they're booting an idea, they're booting a concept that's possibly going to become successful. Maybe some kind of a breaking technology or a breaking process in each of those fields. And it could be pivotal and it could lead to high growth and high profits in the future and higher stock prices, right? So unprofitable at the moment, not a pure startup, more or less an early life thing. And what you're going to see in media narratives and reports, and as you're looking at analysts, is there's going to be a high focus on revenue, right? Not so much on profit, but on revenue. And that basically indicates that the stock or the product that they're trying to bring to market and they're trying to scale has has a market, right? It has reception in the marketplace, maybe with some key players and stuff. And this is definitely not a new thing. You guys may remember that Amazon remained unprofitable before it became a Max 7, Magnificent 7, or a super stock. It was unprofitable for a significant period of time. And I believe, right, so Amazon became profitable in the fourth quarter of 2001. And if we look at Max 7, So yeah, we can see 1997, it's at about 8 cents a stock, and it actually, so that's what, I don't know, 20x, 30x, 30 times that it improves between then and kind of where the dot-com bubble comes in around 2001 or so, and then it comes back down again. So even before it's profitable, it's out there for a while. The market likes the idea, likes the concept, and wants to give it some time to bring it to profitability. And because you have this characteristic with these stocks, you'll see that there is a higher investment in research and development, and the market looks to that and accepts that, and in fact wants to see that, and wants to see a focus on investment in technology, which is going to basically tax your profits in the short run. But that's kind of where the focus on revenue comes in. So revenue lets you know that the product is working, and you can go through the profit loss statement and see all the investment in research and development is, and that may be a drag in profits, but the market is looking towards the future, right? And it may get very speculative in certain stocks, and award them a very high valuation just because they believe that their concept could come to fruition and could reap in high profits. Let's go back to our portfolio. All right. So, yeah, you're going to have a high level of sensitivity to market news and company events. You're definitely going to get wild swings in this kind of a portfolio. So you want to keep it for the long term. Preferably, in my opinion, do not leverage against these kind of portfolios. Don't borrow to buy these stocks. Don't leverage up your positions. And I'm personally not a trader, not interested in short-term price movements for trading games. Looking at a long-term view here, and that probably is the safest way for the layman to do that. And I kind of consider myself not really a stock market insider. I don't spend an inordinate amount of time during the day looking at price movements and things. It's uh, kind of just like a in and out for the day. So you're gonna have that sensitivity, and this point number three over here is very important, and I think it's very timely because at certain points in the market's going to have different sentiments, right? Sometimes it's being euphoric and it's being irrational and highly speculative, and then other times it is more focused on fundamentals. So usually, when you don't have a active bull run going on, or you're in somewhat of a bearish trend, you will get more focus on fundamentals, and we kind of have that right now. Interest rates are high, access to capital is somewhat restricted. The economy is believed to be heading towards maybe a soft recession or some kind of a recession or some kind of a leveling off. So, you're going to get softer GDP, probably higher unemployment, even though unemployment's still at all-time lows. So it's a typical scenario, it's a typical environment where you're going to get higher focus on fundamentals and the ability for these companies to produce a profit and to have a path to profitability. And that's a good thing. That is a really good thing. We definitely want to go through these phases and hopefully get these companies to focus on this and to produce something in this area. Because you just never know when that bullish, euphoric, speculative phase is going to come back again. And you may have a distraction from those fundamentals, and companies going to go out and run after raising capital, and especially when they have high stock prices, that is a very ideal time for them to issue stock and to raise capital because their stock is worth that much more. All right, so and let me also quickly retouch on this box over here. Talked about that in the previous vlog as well. And this is basically because this is a high risk, considered high risk. This is basically what my thinking is. So as far as your own individual situations go, you need to, maybe sit down with your advisor or your certified financial planner or whatever and figure out what your risk appetite is with this. But, I'm looking at something like for myself, maybe 20% of liquid net worth, which means even if I lose everything here, something happens completely unforeseen, like World War III breaks out or something, and the stock portfolio goes down to zero, I'm not gonna have to sell my house, my car, or maybe not visit restaurants as much as possible, or as much as I do, and take vacations as before, but still, we'll be all right. So the risk here is that some of these companies are not profitable and they're shy on the path to profit. They need to show us more in terms of how they plan to achieve to getting to positive EPS, earnings per share, access to capital to continue operations. So their fundamental fuel for operations is not profit right now, it's access to capital. So they need continued access to capital, and that's kind of how the stock dilution works as well, as they need to keep going out into the market and selling more stocks. And at the end of the day, the concept that they're working on may not prove to be pivotal or scalable at a level where it justifies those stock prices. So, basically at the end of the day, there are only so many Amazons and Magnificent Seven stocks out of hundreds or even thousands of picks out there. But at the same time, the opportunity is there. High growth, stocks are on the cheap, they're at multi-year lows, and success can mean higher rewards. So I pointed this out last time. This is kind of our buy point over here, August 15th or so. And the same portfolio was worth 2.7 million back in February 12th, 2021. You can kind of ignore that or completely discount that as something, highly speculative that's just way off fundamentals, and factor in some dilution of stocks as well, and maybe treat this as a more realistic peak. And even this, that's still a very substantial gain. Okay, so let's go ahead and check in on the price points on our portfolio. Here's just a basic spreadsheet that I set up. This is kind of where we came in as per the previous video. And as you guys can see, there's kind of a slight up, well, I want to call the slight 29% uptick in Bionanogenomics, which is a gene mapping biomed company startup. And given this low denominator, that kind of movement is pretty common. But overall portfolio, we're at 5%, but still, only a couple of days, it's pretty meaningless. We're definitely in here for the long haul. Ignore these guys for now. This is just some stuff that I'm looking at. It's under review, under assessment, so possible buying opportunities over the next 6 months or so. But yeah, let's take a look at BNGO real quick, just as an example for now. We'll do a deep dive later. Um, but if we go ahead and pull up their second quarter results, and here's a report by, I think, Zacks Equity Research, where they've been upgraded to a buy after that report. And if we look at their financial statement for the second quarter, so here's that focus on revenue that I was talking about. And this is kind of even more positive in a way because kind of year over year, overall, there's lower economic growth, slightly higher unemployment, um, definitely much higher interest rates. So for the companies, for BNGO to be able to improve the revenue despite all that through second quarter is pretty good. It's a good sign, reflective of good management and good direction. And their cost of revenue, so the cost of producing the revenue, also downticked a little bit. So, it's reflective of the fact that management is likely focused on these areas. And then your operating expense, so selling, administrative, executive management, staffing, everything else, is a pretty substantial decrease. So that's probably why the market may look to reward BNGO, at least in the short term until the next quarter comes out. So it's still just a quarterly stuff. We want to see this trend to continue and for them to still have their focus on research and development as well. So probably quite a bit to ask. But as you can see, the loss, look at total loss, right? Total net loss, still pretty substantial as the company is burning through about $50 million of cash every quarter. But that's pretty typical with these kind of companies. Nothing new at all. Okay, let's move on. And I think for the final piece of this vlog to take a look at the environment and some of the economic factors that are playing out right now. I'll just kind of quickly give my 2 cents. Welcome any comments and feedback. Um, but kind of, yeah, overall, this is the narrative that's kind of been playing out for the last, I don't know, 3 to 6 months or so, maybe even longer than that. But kind of on the bullish side, um, the um, the reasons are more or less that we've been looking at a resilient and defined economy despite a very high interest rate regime. The economy has done well. Inflation definitely has been tamed, and the Fed can start lowering rates in the second half of 24, possibly as early as next month. GDP is still positive and low unemployment, even though the uptick to 4.3% in August, which caused that sell-off. Still very low unemployment levels. And there's this coming AI boom. Exactly what that means. A lot of debate in the market right now. A lot of media narratives coming out about when this wave's gonna filter out. When is it gonna flatten? When is it gonna rationalize? Stocks like Nvidia, which are valued at $3 trillion at some point, fundamentals need to come into play. But that's how the market works. If there is a lot of promise, a lot of value, a lot of positive outlook in a particular sector, in a particular area of the economy, and as AI is expected to add, we don't know exactly how, but a lot of productivity into the economy, that could definitely support the bull run scenario. Bears going to tell you, okay, yeah, GDP is there, but it's falling. There's been overall declining consumer confidence and outlook, although there's been an uptick in that, given that the economy is still growing, inflation is tame, and the expectation that the Fed's going to start lowering interest rates, hopefully fairly soon, and we may see a soft recession or a soft landing. Um, you do have, some consumer sentiment indicators that are starting to pick up and show a little bit more of a positive mood as of very late. But very early to say anything, very much remains to be seen. National debt, yeah, and which is a massive 34 trillion. Yeah, it's a nerve-wracking number. It makes everybody nervous. But I think it needs more understanding, more analysis in terms of what exactly that means. And we'll probably do a video on that at some point in the future as well. And government spending, right? That has a lot to do with economic growth as well. If the government is borrowing a lot and spending, it spurs economic growth, but it can't keep on doing that forever. And whenever there's a pullback there, it's going to have some kind of a meaning for the economy. Rates are still pretty high, and even though the economy is doing well, um, it, it it still is an inflection point in terms of that it could be a trigger for something negative if there's a higher for longer scenario and rates stay high for longer than expected. There is rising consumer credit card and auto delinquencies, right? And this is a kind of a major indicator for the economy, for consumer sentiment as well. So it's a bit of a lagging indicator. If people are feeling better, if they're doing better, um, if they are able to supplement their income after they lose their job and be able to fix their accounts, their delinquent accounts, that trend can change as well. And it's kind of moderated for the time being. And possibly, been read a couple of media reports on this about some kind of a coming commercial RE crisis in 1Q25, and that's kind of why I have the REITs, the real estate investment trust piece in the stock portfolio, kind of open as an open discussion right now as well. But some media reports have indicated that the high interest rate regime, given how high interest rates are, that has not filtered all the way through the system yet and hit these variable commercial real estate mortgage loans. And maybe that's going to happen in 1Q25. And maybe this is a problem, maybe it's not a problem. Definitely, um, given the post-pandemic work from home mega structure, infrastructure that's come up um, in the private economy after the pandemic has had a huge impact on the commercial real estate portfolio. So something is definitely going on over there, and there may be some opportunities. So something to keep an eye on. Okay, I think that's a good place to leave this vlog, kind of keeping these short as possible. And perhaps what we'll do is for the next piece, I'll start talking a little bit more about these watch lists and portfolios that I've got set up in these different sectors, looking at a bunch of different companies within those to see where a good buying opportunity may be. So, we have a sort of a buy point in August 15th. Um, and it may turn out to be a good buy point. It may not turn out to be a good buy point over the long term. Let's see. But one thing we don't want to do is try to time the bottom, right? A lot of conventional wisdom will tell you do not try to time the bottom. If you're close enough to the bottom, and this probably is the bottom, hopefully with these guys. Um, probably a good point to do some buying and then maybe leave some out for a little bit in the future as well. We really don't know what's going to happen. The Fed, the economic fundamentals are pretty strong right now. You've got low unemployment. This is interest rates. Interest rates have gone up. Inflation's come down over here. So good stuff has happened. They've managed to work the monetary policy as it should have. And unemployment, this is post-pandemic. So it shoots up in the pandemic, comes down. It's still at all-time lows. So the Fed could even technically, the markets won't like it, and they probably will react negatively to it. But economically, the Fed could still not lower interest rates in September and maybe even come out all right. So yeah, I definitely agree with this piece of news over here that it's a market problem. It's not an economic one, right? So don't expect the Fed to rescue us. As far as economic fundamentals go, I don't think it's a given that the Fed's gonna lower interest rates. Definitely, my own outlook is that we might see a 25 basis point reduction in September and possibly one more um, before the end of the year. But it's all going to depend on how economic reports come out between now and then. And also, this is a pretty good one as well. If you guys want to check this out, history shows that when Fed cuts rates, it's not always a given that the markets are going to react positively. The Fed cutting rates can mean that things are good, and they've gotten what they wanted, and they can start cutting rates now. But it can also mean that they're worried about something. So it's just how the market chooses to interpret the information. And in this given scenario, given that economic fundamentals are good and the soft landing scenario is looking more and more likely now, probably most likely a Fed rate cut would mean good things. Okie dokie, I think that's a good place to leave the vlog for now. I'll keep these as short as possible. And for the next one, I'll probably get into some of these watch lists and portfolios that I'm looking at. So each of the sectors. So um, maybe lay out this format, this structure, and then start doing some deep dives into these different sectors and even some of these different stocks and some of the ones that I'm maybe looking to pick up over the next 3 months, 3 to 4 months or so. Alrighty, take care, guys, and we'll see you next time.